In Forex, some currency pairs are known for being very liquid, like the major ones involving the US dollar,
Yeah.
euro, or Japanese yen.
Okay.
Those are very liquid.
So I'd probably want to stick with those more liquid pairs, at least when I'm starting out, right?
That's generally a good idea, especially when you're still getting comfortable with the market dynamics. Now let's move on to volatility.
Okay.
If liquidity is about how easy it is to trade,
Yes.
volatility is about how much the price of a currency pair jumps around.
So high volatility would be like a roller coaster, lots of ups and downs.
Exactly.
Low volatility would be more like a smooth train ride.
Yeah, great analogy.
Okay.
High volatility pairs can be exciting,
Uh-huh.
offering the potential for big wins but also big losses.
Right, of course.
They're often influenced by things like economic data releases, political events,
Okay.
or even rumors and speculation.
So I need to be prepared for a wild ride if I'm trading those more volatile pairs.
Yeah.
I'm guessing choosing the right currency pair depends a lot on my risk tolerance and trading style.
It really does.
Okay.
It's all about finding that balance between potential reward and risk.
Makes sense.
Now, you also mentioned different types of orders.
Yes.
We already talked about stop loss and take profit.
Right. Those are like my safety nets
Yes.
and profit capturing mechanisms. But you mentioned other types of orders too.
I did.
What are those all about?
So when you place a trade,
Uh-huh.
you have to tell your broker how you want that trade executed.
Okay.
The simplest type is a market order.
Okay.
Think of it like saying, buy this currency pair right now
Okay.
at the best available price.
Okay.
You're not setting a specific price.
Gotcha.
You're just getting in at the current market rate.
So if the market is moving quickly, a market order could fill at a slightly different price than what I was looking at on the screen.
That's possible. Yeah.
Okay.
If you want more control over the entry price, you can use a limit order.
Okay.
It's like saying, only buy if the price reaches this specific level or better.
So a limit order gives me more precision.
Exactly.
I can set my target and wait for the market to come to me.
Yep.
What about those stop orders you mentioned earlier?
Yeah.
Are they related to stop loss orders?
They are related,
Okay.
but with a key difference.
Okay.
A stop loss order is already an active order. Yeah.
Designed to limit losses on a trade you've already entered.
Okay.
A stop order, on the other hand, is like setting a trigger for a future action.
Okay, so if I think a currency pair is going to break through a certain price level and then keep moving, I could use a stop order to enter the trade automatically once that level is hit.
Exactly. It's a way to catch a potential breakout move.
Okay.
Or
Yeah.
you could use a stop order to exit a trade if the price moves against you, similar to a stop loss,
Okay.
but typically set further away from your entry price.
So it's all about choosing the right order type for the specific trade and market conditions.
For sure.
Now I'm feeling ready to tackle some of those more advanced Forex concepts.
Right.
What else is out there?
Well, as you get deeper into Forex, you'll come across terms like hedging, swaps,
Okay.
margin calls, and drawdown.
Right.
These are all important pieces of the puzzle.
Lay it on me. I'm ready to level up my Forex knowledge.
Okay, let's start with hedging. Okay.
Imagine you have a trade open that's currently in profit. You're happy with the gains so far.
Yeah.
But you're also a bit worried that the market might turn against you.
Okay, I've been there.
Yeah, we all have.
What can you do? Just hope for the best?
You can hope for the best.
Okay.
But a more strategic approach would be to hedge your position.
Okay.
Think of it like insurance.
Okay.
Hedging is basically taking an offsetting position to reduce your potential losses if the market moves in the opposite direction.
Interesting. So it's like having a backup plan,
Yeah,
just in case things don't go as planned.
exactly.
Okay, what about swaps
Okay.
or rollovers?
Yeah, so these refer to the interest that's either earned or paid for holding a position overnight.
Okay.
Remember, when you trade Forex, you're essentially borrowing one currency to buy another.
Right. It's all about the exchange rate between those two currencies.
Yeah.
But how does interest come into play?
Well, each currency has its own interest rate.
Okay.
Set by its central bank.
Yeah.
When you hold a position overnight, the difference between those interest rates can result in either a small profit or a small loss,
Interesting.
depending on which currency you're borrowing and which you're holding.
So it's like a mini interest rate game happening in the background of every Forex trade.
Yeah, pretty much.
That's fascinating. Okay, what about those margin calls we talked about earlier?
Yeah.
Those sound a bit scary.
They could be a wake-up call, that's for sure.
Yeah.
A margin call happens when your account balance falls below the required margin level to keep your trades open.
Okay.
It's like your broker saying, hey, you need to put up more money to cover potential losses, or we're going to close out your positions automatically.
Oh, wow. Okay.
Yeah.
Definitely something I want to avoid.
Yeah, for sure.
Okay. Last one on the list. Drawdown.
Oh.
What exactly does that mean?
Drawdown is simply the peak to trough decline in your account balance. It's a measure of the maximum potential loss you've experienced during a trade or over a certain period of time.
So it's like the worst case scenario.
Yeah.
The biggest dip my account has taken during a particular trade.
You got it.
Okay.
And understanding drawdown is a crucial part of risk management. You want to make sure your trading strategy and position sizing are aligned with your risk tolerance and the potential drawdowns you're comfortable with.
Makes sense. It's all about being prepared for the ups and downs of the market.
For sure.
Now, we've talked a lot about currency pairs.
Right.
But are all pairs created equal?
That's a great question.
Yeah.
You see, in Forex, you have different types of pairs.
Okay.
There are the major pairs, which involve the most heavily traded currencies like the US dollar, euro, Japanese yen, British pound, Swiss francs, and a few others.
Okay.
These tend to be the most liquid and often the least volatile.
So those would be the ones I should probably focus on as a beginner.
They're a good starting point. Then you have what are called currency crosses, as the name suggests.
Yeah.
These pairs do not involve the US dollar.
Okay.
A classic example would be the EUR-JPY pair, which represents the euro against the Japanese yen.
So any pair that doesn't include the US dollar is considered a currency cross.
That's right.
Got it. But why would I trade those instead of the major pairs?
Well, currency crosses can offer different opportunities.
Okay.
And sometimes have unique correlations to other markets.
Interesting.
They can also be influenced by factors specific to those two countries involved.
Okay.
Rather than being driven primarily by US dollar movements.
So it's another way to diversify my trading strategy.
Exactly.
Interesting.